We'll continue our discussion on valuation models in which we were discussing about DDM. But before we discuss further about this dividend discount model, let's recap what we have done so far. We introduced you the concept of absolute valuation method, and we also discussed about the relative valuation method. So in this we said that this gives us true value, or we also call it intrinsic value. And in this it basically compares certain ratios with comparables. These are peer companies, and we understand whether the company is overvalued or undervalued. So pretty much what we get out of these two outcomes would be very different. This would be in the form of a ratio. It's not an absolute number. And in this what we'll get is basically a true value. A number, as you would remember the example of Microsoft in which we mentioned it was operating at 28.09. We'll be able to arrive at a particular number, whether that's 35 or 25, depending upon the forecast and everything. With respect to relative value, we'll be able to just tell whether it's undervalued or overvalued, and accordingly we'll decide what we need to do with it. We need to buy or sell the stock. So this is basically the first topic we discussed, where we introduced you the difference between the absolute valuation model and relative valuation model. Then we started discussing about the absolute valuation model. We started with dividend discount model. These are present value-based models, and what we are trying to do in dividend discount model is basically discount future dividends and bringing it back to the present time, and that is our current price expectation, and accordingly we can decide whether we need to sell or buy the stock. So in this what we did was we introduced you the formula of 1-year DDM or 1-period DDM. And this what we mentioned was D1 plus P1 / 1 plus R. And in this D1 is the dividend which we expect by next year in 1 year. This is the price of the share in next 1 year, and we discounted by the rate. This is the cost associated with this. So this is the cost of equity basically, because we are looking at dividend, and dividend is paid to equity holders. We also introduced you the formula of multi-DDM. And this what we did was we introduced you the formula where we set the 1 by 1 plus R and D2 by 1 plus R raised to the power 2. And at the end it's basically the Dn divided by 1 plus R power n. We also solved one example on multi-dividend discount model. Now we take the multi-dividend discount model discussion further. As you see that in dividend discount model, we have to arrive at what is the dividend which is expected to be paid out in 1 year or 2 year, in another year. So this kind of calculation is something for which there would hardly be any information available. So for an analyst, applying DDM will be very, very difficult. So how we really work around arriving at this number is basically use a few models which help us forecast the dividend. We need not have all these numbers built in. Basically we'll just use that model in order to arrive at the expected dividends. So one of the model which is popularly used for this purpose is Gordon growth model. This is a very, very popular model in finance world, and it's extensively used not only in DDM, you'll also see it in DCF valuation. Gordon growth model is built on certain assumptions. One of the basic assumption is dividend will be paid in future as well, and you know growth will happen till infinity. The company's dividend will continue to grow till infinity. This is based on the assumption that company is forever. Company stays forever. Under Gordon growth model, it's assumed that when a company's existence is forever, its dividend also grows at a constant rate till infinity. And the other assumption is that the expected growth of a company is similar to economic growth. So if a company is growing at an exorbitant rate in comparison with the economy, then Gordon growth model will not work. The last assumption is the most critical assumption, is that the cost of equity is greater than dividend growth rate. You can see the formula here that value is equal to dividend multiplied by 1 plus growth divided by cost of equity minus growth. So this formula is basically derived from the dividend discount model only. So once this is solved, there is a mathematical equation. We will not get into the mathematical calculation because it requires a very lengthy calculation, and that is not at all used in your day-to-day work. But you should just remember this formula. Gordon growth model is derived from this equation only, the dividend discount model equation only. So under this, what we say is value in today's time is equal to dividend which is paid this year, or the current dividend 1 plus the growth rate. And this whole divided by R, which is cost of equity minus growth. This really defines the Gordon growth model.